Hey, this is David Wakefield of Prime Lending, and I'm here to talk to you today about a special loan product that's designed to help people buy based on cash flow, and that's going to be our DSCR loan. So before we get into that, though, let me tell you a little bit about myself. Again, I'm David Wakefield with Prime Lending. I've been in the mortgage business since 1994. I've helped somewhere in the arena of, say, 4,000 or so people get mortgages over that time. So I've seen about every scenario out there. So I'm here to get people keys to their houses. I'm here to get these loans approved for my clients and for the real estate agents. So in this, whether it be a first-time home buyer, who needs down payment assistance, someone who's looking to renovate their house, somebody building a home new construction, or someone just seeking credit counseling because they need some guidance on how to get to that next step, I'm here to help you out. But today we're talking about the DSCR loan, and this is all based on cash flow. So debt service coverage ratio is what the DSCR stands for, debt service coverage ratio. So when you're buying a property and we're doing the DSCR loan, it's all based on the cash flow of that property. So when I look at this, if your mortgage payment is $2,000 and then you're gonna rent it out for $2,500, you divide that and that gives us 1.25% for the debt service coverage ratio. So based on that, that's a loan in theory that we could do based on that number. So now this is not for everyone certainly, but this is designed a lot of times for people that, number one, don't want to have to worry about the tax returns or pay stubs or W-2s and things like that. Sometimes that could get a little complicated. Maybe there's more income in the household that's coming in that we can't necessarily see for one reason or the other. A spouse perhaps that's working, but maybe their credit's not good enough. There's lots of reasons why this loan might be a good one. But it's designed for people to buy based on cash flow. And the advantage is it's simple. It's super, super easy for people. So how it works basically. Well, your down payment is going to be 20% down, so an 80% loan to value is usually what we're looking for. Now, the more money you put down, in theory, the better the terms. So it's going to be on a 30-year fixed rate mortgage. We might have different options with a few different investors, but basically we're looking at this as a loan that's going to get in 20% down. You'd be doing that anyways, most likely if you're buying an investment property, but you'd be providing tax returns and a lot of documentation, which could be a bit of a hassle in getting you approved. Now, with this, just so you understand is we're going to verify your employment, right? We're going to put the employment information on there, but we're not going to get pay stubs or W-2s or tax returns because it's all based on the debt service coverage ratio. That's what it's all about. So your minimum loan amount most of the time on these products will be maybe about $150K, to $200K on the minimum. And you can see those numbers go up quite a bit. I had a friend personally, he bought 2 houses using this, both well over $1 million, which, hey, good for him. And they're renting out and he's cash flowing just fine. But this is not the loan for the $50,000, investor or $80,000, property, or even really, I don't think $100,000. There's a few investors that we can look at that we can evaluate. But for the most part, this is somebody who's buying a property that's going to be financing somewhere, 150 up on the purchase. So minimum credit score, you can go down on these as low as 620 in most cases. And that's pretty much it. So basically, if you want to buy a house, you don't want to provide the documentation for tax returns for income and such, and you just want it approved on the debt service coverage ratio, then we can take care of you with that. Now, what are the terms going to be? Well, I'm not going to say rate specifically because, of course, rates are going to change every day, but just understand that the higher the credit score, the more down payment you put into it, the less risk, therefore, the better terms. So the best terms are going to be in that situation if someone's making a pretty substantial down payment and they've got a high credit score. In that case, your rate might be something in the vicinity, close to what the current market is, maybe about a half a point above that. As the scores go down, and if we're tapping on that 80% max loan to value range, that's where you're going to see the terms are going to be more expensive, maybe another 1.5 points or maybe 2 points higher than what the going market might be. So bottom line is it's simple, it's easy, it's a way for you to obtain your property. And if you have any questions about this loan product or anything else, please don't hesitate in reaching out. You can always find me at www.davidwakefield.com or just give me a shout on my cell at 904-237-1450. Thanks so much, and until next time, we'll see you later.